Hey everyone, welcome back to the channel. Most people are taught to think about sovereign debt crisis and household financial distress as two completely different worlds. One belongs to bond markets, central bank, and higher boardrooms. The other belongs to family trying to make rent, keep up with loans, and survive rising costs. But what if that separation is the real illusion? What if the reason so many sovereign debt solutions fail is because policymakers keep looking at government spreadsheet while ignoring the actual condition of people forced to carry the economy underneath them? Because once you see the difference, once you see the connection, the whole picture changes. This bar chart tracks external debt outflow for developing nations over the last 50 years. And between 2022 and 2024, those outflows hit a 0.5% repeat. In that period alone, developing nations paid a record $415 billion just in interest. Not principal, just interest. Capital left those countries at a historic scale, while the debt itself remains standing. And over that same period, something has happened at the household level. In the United States, for instance, more than $2 trillion in student loan forbearance ran through the system. Across Europe, mortgage suspensions became widespread. So at the same time, sovereign debt pressure was peaking, households were also being given breathing room just to avoid breaking. Standard macroeconomics analysis usually treat those developments as separate. Sovereign external debt is framed as a problem for international creditors, bond market, and national treasury. Household distress, on the other hand, is treated as a consumer issue, a domestic issue, or local issue. But that division creates a dangerous blind spot, because the domestic financial system is the bridge between the two. It is the tissue connecting the citizen's wallet to the state's borrowing costs. Commercial banks sit right in the middle of that grid. They take local deposits, issue household loans, and at the same time, they buy government debt. So if you evaluate sovereign debt without evaluating household financial resilience, you're missing the structure that actually holds the systems together. That is the core argument I'm trying to make here. A country's ability to survive an external debt crisis is not just about top-line GDP, export numbers, or what some debt sustainability spreadsheet says in Washington. It is ultimately about whether the domestic banking sector can absorb pressure. And that in turn depends on whether ordinary households can keep functioning. Now look at the pressure coming from the global rate environment. Across multiple advanced economies, the cost of borrowing has steepened aggressively. Yield curves have shifted. Short-end borrowing costs have soared. And for developing nations, that means one thing very quickly. Rolling over debt becomes far more expensive. Refinancing becomes skinny. Liquidity gets squeezed. In 2024, bond investors still poured around $80 billion into new financing for developing economies. But that money came in at average interest rate around 10%. That is roughly double what many of these countries were dealing with before 2020. So yes, the money still arrived, but it arrived poisoned by cost. And once those rates move that high, traditional market and financing start to shut down. Heavily indebted nations get priced out. They can now refinance cheaply, they cannot stabilize smoothly. And when access to private capital begins to fail, they turn to the lender of last resort, which is the IMF and the World Bank. That is where the global system likes to present itself as responsible, technocratic, and stabilizing. But here's the real question. Stabilizing for whom exactly? Because rising global yields do not just make governments change their borrowing tactics. They force government to stretch for lifeline. And when external lifelines dry up, those governments start leaning inward. They turn towards domestic financial resources. They start pulling from the local system. That is where an international sovereign crisis begins to expose internal economic weakness. The first major international response to this problem was Debt Service Suspension Initiative, or DSSI. On paper, the idea sounds helpful. It was supposed to provide immediate liquidity, and the mechanics are straightforward. Official bilateral creditors temporarily suspended debt service for 73 eligible low and lower middle-income countries. The goal was to stop cash from leaving the sovereign layer of the system so government could redirect the money to crisis response, schooling, and primary health care. But notice the key word here, suspended, not canceled, not reduced. It's just suspended. That means the clock process, but the debt itself does not disappear. The principal remains fully intact. In some cases, interest keeps accumulating. So the sovereign gets temporary breathing room, while the wall it has to climb later gets taller. That is the difference between a liquidity crisis and a solvency crisis. Those sounds technical, but the distinction is simple. A liquidity crisis means you do not have enough cash right now. The solvency crisis, on the other hand, means that even over time, the system does not generate enough income to truly pay the debt down. One is a timing problem, the other is a structural impossibility. And that is where a lot of official intervention becomes deeply misleading. Because if the underlying economy cannot outgrow interest burden, the imposing payment does not solve the problem. It simply extends the problem, pushes the can down the road. For instance, countries like Chad, Ethiopia, and Zambia still face structurally unsustainable debt loads even after the DSSI passed. So what was presented as relief often functions more like delays. Eventually, that forces a deeper step, restructuring. That is where G20 framework for debt treatment comes in. Unlike suspension, restructuring aims to change the debt itself, not just the payment calendar. The process is usually built around IMF's debt sustainability analysis. That is a technical model designed to calculate the maximum amount of debt the country can carry while still function. In plain English, it's supposed to answer the question, how much debt can this country survive without collapsing? Then comes another technical phrase, comparability of treatment. That means all major creditors groups are supposed to share the pain proportionately. Private lenders, bilateral lenders, multilateral institutions, nobody is supposed to demand full repayment while everyone else takes the loss. At least that is the theory. And one of the key tools used in that process is called the net present value reduction. Again, technical phrase, simple idea. It simply means shrinking the real economic burden of the debt to the level the country can actually sustain. So far, this all sounds very orderly, right? Very rational, very professional. But here's the problem. During this negotiation, credit often dries up. And when external money disappears, sovereigns start turning to local banks. That means domestic banking starts moving upward to finance the state. And once that happens, the sovereign crisis is no longer just an external debt problem, it becomes an internal banking problem. For instance, out of 86 tracked developing countries, more than half now see their domestic government debt growing faster than the external government debt. Think about what that means. Governments that cannot simply finance themselves abroad begins leaning hard on the local financial system. And when government borrowed every little at home, they absorb capital that otherwise would have gone to businesses, households, and productive domestic activity. That is what economics call crowding out. Plain English, the state soaks up the money, everyone else gets squeezed. Private investment slows down, internal growth stalls, and the foreign sovereign crisis gets converted into a highly localized domestic credit problem. Now we get to the bottom layer of the whole structure, the household. And this is the layer that institutions consistently underestimate. In many developing and emerging economies, wealth is highly concentrated. That means the majority of the household operate very thin buffer, very little margin, very little resilience. So when inflation spikes, employment falls, or financing conditions tighten, these households do not absorb the shock, they go straight into distress. And when millions of households go into distress at the same time, you get widespread forbearance, you get debt modification, you get payment suspensions, not because households are gaming the system, but because they're trying to survive it. This is where economists use the term marginal propensity to consume. Again, simple translation. From household near the bottom, any cash trade-off from reduced loan payment goes immediately towards necessity, like food, transport, medicine, just basic survival. Not savings, not investment, not financial rebuilding. And that matters because household restructuring is not frictionless. Creditors worry about moral hazard. That means the fear leniency will encourage more defaults. There's also something called hold-up problem. That sounds abstract, but simply means multiple lenders often cannot agree on how to structure a single borrower's debt. Everybody wants protection. Nobody wants to go first. But while the institution argue, household keeps deteriorating. Now, following the losses upward, unpaid mortgages, personal loans, consumer debt do not stay at the household level. They migrate onto the books of the domestic commercial banks. That means household distress becomes bank distress. And this creates a central paradox for the entire system. The domestic banks are already absorbing massive household losses. How exactly are those supposed to absorb structural sovereign debt? Can't, not indefinitely. The state's internal lifeline gets severed. And once that happens, the real sovereign lending is exposed. A country's repayment capacity is not determined only by what its government owes abroad. It is capped by the financial resilience of its domestic household. That is just a deeper truth. The median household is not some side issue in sovereign risk. The median household is the foundation of sovereign risk, which means wealth inequality is not just a social problem. It's a default risk variable. It directly shapes the probability of sovereign failure. And yet, standard adjustment programs still rely heavily on top-line GDP, export data, recovery level ratios, while treating household stress like background noise. It is not just complete. This is flat-out intellectual dishonesty. Because if you ignore household stress, build a recovery model that the local economy cannot actually fund. And the human cost of that error is enormous. In the most highly indebted developing nations, on average, 1 out of every 2 people cannot afford the minimum building diet necessary for long-term health. Half the population is already falling below the nutritional line required to remain economically functional. And policymakers still want to talk as if this is mainly a spreadsheet calibration problem. When a large part of the population stops spending, when they become too physically strained to remain productive, the state loses that capacity. And when it has capacity for it, the sovereign balance sheet weakens further. So the household crisis flows back into the sovereign crisis all over again. That is the loop. Keep pretending it's not central, which means any serious recovery framework has to integrate household microdata into sovereign restructuring. It is no longer enough to model only the sovereign and maybe the banking sector as transmission layer. You have to scan all 3 layers together: the sovereign, the commercial banks, and the median household. Only then you get an honest picture of total carrying capacity. And during the sovereign restructuring, domestic commercial banks need exclusive protection from localized distress. Why? Well, that's because they get it from both directions, from above through government restructuring, and of course from below to household defaults. If you did not protect that middle layer, the whole transmission mechanism fails. So policymakers face a real balancing act here. They have to cut external debt deeply enough to give sovereign debt room, but they also have to preserve internet credit supply that keeps the domestic economy alive. That means international debt relief cannot just be negotiated in conference rooms with foreign bondholders. It has to be calibrated to internal reality. It has to be the local wealth distribution. It has to be calibrated to the financial condition of the actual household. Because ultimately, the true arbiter of national survival is not just the sovereign spreadsheets. It is the financial health of the median household. That is the layer global debt architecture keeps trying to turn secondary. And that is exactly why so many recovery paths fail in the real world. They are built from top down, why collapse is happening from bottom up. If you find this breakdown valuable, thank you for being here. And if this kind of analysis is useful to you, consider subscribing to the channel. I appreciate you watching. See you in the next one.